Today's session shows a clear sell-off in U.S. equities. The S&P 500 and NASDAQ are both lower, but the key signal is that yields are falling, not rising. This divergence tells us something important about risk appetite and market expectations. We will break this down using three indicators: the 10-year Treasury yield, SPY, and QQQ. We will also connect these moves to current macro news and sentiment. The 10-year Treasury yield is trading near 4.208%, down significantly on the session. This represents a sharp intraday decline, suggesting investors are bidding bonds higher. A drop in yields typically reflects a flight to safety. Today's yield action confirms that traders are reacting to weak economic data and tech sector selling. This aligns with recent reports showing a cooling labor market and elevated risk aversion among investors. The move lower in yields reflects increased demand for safety assets amid uncertainty. SPY is trading near $679.41, down almost 1% on the session. Price action shows a clear breakdown from earlier levels. The ETF drifted lower throughout the day as buying support failed. This pattern is consistent with broader market weakness. Both the S&P 500 and NASDAQ have been under pressure due to weak tech earnings signals and risk-off sentiment. Importantly, the sell-off in SPY coincides with falling yields, indicating that the drop is driven by risk reduction rather than outright panic. Investors are reducing exposure across sectors, not just tech. QQQ is trading near 599.14, down more than 1%. Tech stocks are under pressure again today. QQQ's decline mirrors broader weakness in mega-cap technology names. Several news reports indicate investor concern over AI spending, weaker demand, and cautious earnings outlooks in large tech companies. This selling is not limited to one or two names. It's a broader rotation out of technology. QQQ underperformance confirms that risk assets are losing support even as Treasury yields fall. This divergence, equities weaker while yields drop, points to a cautious market environment. Broader market news today reinforces this analysis. Reports indicate that major tech stocks, including Alphabet and Qualcomm, are under pressure despite earnings expectations. Economic data also shows signs of softening in the labor market and increasing jobless claims. These trends help explain why bonds are trading up while equities trade down. Investors are pricing in slower growth and higher uncertainty. The session shows a clear risk-off tone. Treasury yields are falling as investors seek safety. SPY is weakening, reflecting broad market selling. QQQ is underperforming, driven by technology sector rotation. This combination suggests that the sell-off is driven by risk reduction and macro uncertainty, not just technical levels. Until we see a stabilization in sentiment, perhaps driven by stronger economic data or clearer guidance on rates, this environment remains fragile.